If you're talking about a company that's in distress levels or near distress levels, what gives you that confidence that that ends up paying off?
I would say value.
Howard Marks sat down for an interview with Bloomberg today and spoke about how he's investing in 2023. Recently, Marks has been explaining the new investing paradigm that we're entering after the easy money conditions of the past decade. He calls this shift a sea change, something he's only seen 2 other times in his investment career. Today, I'm going to be explaining Howard Marks' investment strategy for 2023 and how his core philosophies can be used by the average investor in order to do well given these uncertain economic times. In the new Bloomberg interview I'm going to share today, Marks breaks down the kinds of investment opportunities that his firm Oaktree are looking for in 2023. But first he gives a quick summary of what he calls the sea change, a dramatic change in how the financial markets will function over the coming decades.
We had the longest economic recovery in history. It was easy to make money.
Right.
We had low-cost capital. It was easy to make a profit. Everything was easy at that time. And in the last year, of course, with the appearance of the inflation and the increasing of rates to try to stamp out the inflation, things have gotten harder. I imagine people today saying, well, when are we going back to normal, like it was 5, 6, 7 years ago? And the important thing to know is that that wasn't normal.
The sea change that we're currently seeing in the financial markets began about 18 months ago when the Federal Reserve ended the near 0% or 0% interest rate environment that had existed for so long. From 2009 to 2020, the Fed lowered interest rates to 0% and did a significant amount of bond purchasing known as quantitative easing. Quantitative easing, or QE for short, is a type of monetary policy that central banks around the world, such as the Federal Reserve in the US, can use in order to stimulate the economy. Central banks can buy different types of securities, which are typically bonds, in the open market with the goal of lowering interest rates on the bonds and essentially pushing money into the financial markets. In the US, quantitative easing was used between 2009 and 2014. And in that circumstance, the Federal Reserve mainly purchased treasury bonds and mortgage-backed securities. This helped stimulate the economy in a couple of ways. First of all, they were able to drive down interest rates on treasury bonds, which helps the government when they want to issue a lot of debt to do so at a far lower cost of capital. But it also drives down the cost of debt for individuals and businesses so that individuals can spend more money and businesses can invest more into future projects and growth. But those easy money conditions are now over, and Marks believes we've entered a completely different financial environment.
The economic world is not supposed to be easy. It's not supposed to be easy to make money.
Right.
Or, it's not supposed to be easy for companies with bad business models to stay in business. So I think we go back to a period in which we have moderate interest rates, we have moderate availability of capital, we have a moderate default rate, and so forth, all of which will feel much less accommodative, I think, than the last 14 years.
With high inflation and high interest rates, it's more expensive for businesses to invest in growth, harder for them to survive default, and consumers have less money to spend due to higher cost of living and cost of debt. And the truth is, most of us investing today have only invested in a period where interest rates have been extremely low since 2009. So while many people, and maybe even the main narrative at the moment, is that interest rates are going to go back to being rock bottom after a temporarily being elevated slightly to get inflation under control, Marks doesn't see it that way.
The events of recent years tell me that it's not great to have interest rates at zero. Zero interest rates are really an emergency measure. Somebody gets a heart attack, you give them a shot of adrenaline. Works.
Right.
That doesn't mean you start your day with a shot of adrenaline every day for 7 years.
0% rates are not sustainable because it's too stimulative and ultimately drives the value of the currency to decline. And on top of that, if interest rates are at 0% and a recession hits, there's no lever that the Federal Reserve can pull in order to stimulate the economy. And that's dramatically different to previous recessions such as 1990, where rates were lowered from 10% to 3%, a massive stimulative move that saved the US from a prolonged recession. So how is Marks investing during this sea change, and what principles can we draw on in our own investments? Howard Marks runs Oaktree Capital Management, a firm he founded in 1995. The firm has $147 billion of assets under management, with many different investment vehicles focused across 4 asset classes: credit, real estate, listed equities, and real assets. Of the $147 million in assets under management, $102 billion is invested in credit or debt securities. There are many different types of debt securities that Oaktree invests in through their funds, but Howard Marks spoke about a particular type of debt security that is of interest to him at the moment in the latest interview.
If we as creditors can buy the debt of a company that we think can stay in business because it has a good business model and some margin for error in tough times, and if we can buy the debt at a place in the capital structure where we create ownership in that company potentially at a reasonable valuation, that's what we look for.
Marx is describing a type of debt security called a convertible note, which is essentially part equity, part debt. How this works is Oaktree will first look to lend money to companies that are under some kind of financial distress. They'll then lend money to these companies at a fixed interest rate that will have to be paid usually every half year or every year until the maturity date where the full principal of the loan is paid back. That arrangement is what's called a corporate bond or a corporate note. Note usually meaning borrowing periods between 2 and 10 years, and a bond is a period beyond 10 years. A convertible note, however, is one where the note can be swapped for shares in the company. So it's a debt security with a fixed interest rate that has the option to be converted into an equity ownership position in the company. An example of this was done by Webjet in 2021. They issued convertible notes with a coupon or interest rate of 0.75% per year. And as you can see, those notes could be converted at a stock price of $6.35 per share, which was a 22.5% premium over the stock price at the time. And the stock had a maturity date in 2026, so they were looking to borrow money for 5 years. Investors in these notes would have to consider the likelihood that the business is able to actually make its interest payments. But assuming the risk of default is relatively low, then these types of securities allow an investor to limit their downside to a fixed rate while not limiting their upside, with the option to convert that debt security into equity and become a shareholder in the company. Marx is particularly attracted to these kinds of deals because they are complex and many stock and bond holders overlook them. With less investors focused on these kinds of deals, there's more inefficiencies in the market where the price of convertible bonds has an asymmetrical risk-reward profile. And I know what you're thinking, how on earth can the average person know how to invest in these kinds of securities? And the truth is, you probably can't. Oaktree and other firms that do these kinds of deals are mostly doing private deals that are actually not even available to the average retail investor. So even if you had developed the skills to identifying mispriced convertible notes or convertible bonds, you're very limited as a retail investor in your ability to invest in these kinds of deals. And it's something that's really only available to sophisticated investors who have large amounts of capital. But that's okay, because Marx talks about some key investing principles that do apply to his debt security investments, but also apply to other types of investments that are available to the average investor.
We're what's called bottom-up investors. We're not strategic. We don't say we want to have so much in America and so much in Europe and so much in steel and so much in paper. And let's find some companies. We just look for pieces of paper that look reasonable from companies that we think will stay in business.
Marx isn't using his knowledge of macroeconomics to allocate capital to particular countries or asset classes. He's simply focused on finding the best individual investment opportunities regardless of where they are. Most of that for Oaktree is debt securities, but the firm also invests billions of dollars into publicly listed companies and other asset classes such as real estate or infrastructure. So don't let what is happening with interest rates, inflation, or other macroeconomic factors influence where you invest. Look for companies that are of high quality and likely to thrive in a variety of economic conditions, so when economic conditions do weaken or a recession hits, you don't have to worry about the business being able to survive through that weak period. For a high quality business that's in strong financial health and run by great people, a recession is simply a temporary slowdown in business, and often an opportunity to increase your investment in that company at a lower price. Marx's main guiding principles are risk control and consistency, so focus on limiting total loss of capital first. You may have heard a famous Warren Buffett quote, rule number 1 of investing is don't lose money. That doesn't mean that the stocks in your portfolio won't go down. Even great companies see their stock prices draw down from time to time. But avoid companies that are unprofitable or carry a lot of debt, because they have a higher chance of failing and wiping out your investment entirely. Another common way that investors lose all or most of their investment in a particular company is by overpaying and speculating on a high growth company. It's tempting to want to invest in a company that has been growing at 40, 50% per year for the last few years, but with those kinds of companies often comes an extremely high stock price that is only justifiable if that growth continues for an extremely long period of time. And in most cases, it doesn't. And the result of that means that the stock price gets crushed. So even if the company ends up surviving and ultimately being a good business, the price you pay for the stock could lead you to lose most of, if not all, your capital. And then you want to look for consistency in your portfolio. If we use baseball as an analogy, Marx looks to have a high batting average over going for home runs. And that principle can mean different things for different investing strategies, but at least for me, it means I only invest in companies where the most likely outcome is that I do reasonably well. After, of course, ensuring that I'm not going to have a total loss of capital in a particular investment, I'm making projections for what I can get out of that investment over time based on very safe, conservative modeling. I'm never making high growth projections for a business. I want to be sure that when I invest, what I've modeled out is very likely to occur. Of course, I do try and look for asymmetry where the business might be highly likely to do reasonably well, but has the opportunity to do exceptionally well. I just don't invest with the assumption that it is going to do exceptionally well. I assume that it's going to do moderately okay, and if I can get it at a price where I still make an acceptable return, then that's great. And if they go on to outperform my expectations, that's even better. Finally, Howard Marks abides by one of the core tenets of value investing, margin of safety. Margin of safety was coined by Benjamin Graham almost 100 years ago and refers to paying far less than what you believe an investment is worth. There's really two purposes here. One is to allow for errors in your own projections, your own modeling, but maybe more importantly than that, to allow for random unknowable factors in the economy that can influence how much cash a business ultimately returns to you. If you're planning on investing in a business and owning that business for a decade or more, that business is certainly going to be subject to a number of different economic and non-economic factors, and some of those things will ultimately limit how much cash you can pull out of that business. And while we can't predict these events, we can protect against it by paying about 50 cents on the dollar of what the business is actually worth. That way, even if a bunch of random unknowable factors influence the business, we're still likely to receive or earn the return that we desire. Let me know which investors you'd like to hear about next by leaving a comment down in the comment section below. And if you've enjoyed the content, I'd really appreciate it if you could just hit that subscribe button. It helps me out a ton in growing through YouTube's algorithm. But other than that, hope you guys have a great day. I'll see you in the next one.